Hello and welcome. You're watching India Market Open, and it's fortunately Friday. The week is coming to an end because what we are seeing across the world is not good this morning. Yesterday we were excited. This morning Niraj is still smiling, but we are disappointed. It finally seems like what's good for the economy or what's bad for the economy is finally turning bad for stocks.
Yeah, well, one swallow does not a summer make, hopefully, from a bull's perspective, I'm saying. But who knows?
Eternal bull.
No, just saying that it's brought crude prices lower, it's brought yields lower. At some point of time, maybe that reflects. Plus, we are in a regime over the next 6 months wherein rates will come off.
The first of the rate cuts the first bugle has been sounded by the Bank of England yesterday as well. But no,
buy the rumor, sell the news.
Maybe that
Sorry,
too.
that's my opinion.
The last 4 years, Samina, that hasn't quite happened because the markets have followed the Fed. So let's see if this time.
So maybe it's a little bit of an interim consolidation, and once the rate cut actually happens, they would resume a rally. Who's to tell?
My simple point is how can overnight the whole narrative of a resilient US economy turn into recession fears? Can that really, because of one data point which has been the culprit, one data point majorly which has been the culprit of all of this? So, okay, let's tell you what's happening very quickly. Tough day at the office for any US investor. Day of pain in US markets. The Dow was down 500 points. All three key indices are really seeing a lot of pain. Nasdaq down 2.5% as well. A whole lot of factors contributing to that. Key in that would be the US weekly jobless claims, which came in yesterday. Remember, important set of jobs data is going to come in later tonight, India time. But this number at 249,000 versus an estimate of 236,000 did spook the market. You had factory data which came in poorer than expected, and all of these data sets have compounded fears that maybe the Fed has taken too long. September could be too little too late, as Samina mentioned. But also, even if you see September rate cuts, has the damage of higher interest rates to the economy already been done? Have you missed that window for a soft landing? That's broadly what the fear is. Now, the kind of numbers which came in post-market close in the US for tech companies has not really helped. Intel has poor numbers and also has sacked people, so that stock dropped 20% in post-market trading. Amazon dropped about 7%, missed their revenue targets for the quarter. They have a poor forecast, and they're saying that the Trump assassination bid and other factors have hit their sales numbers. I don't think the street is really buying it. So what happens now? The payroll data for the month, which comes out on Friday, will be very, very crucial to help gauge the economy. That's the non-farm payroll data. They will be looking at that. The unemployment rate will be looked at as well, because if you remember, Jerome Powell spoke again and again on the employment data coming through. They need to watch very, very carefully if they've just gone too far with that a high interest rate regime. Crude prices, though, did soften, rebounded slightly after that, actually. Brent still at 79.83. So after the initial dump down, did rebound. Bonds obviously slid. Lowest levels since Feb on the 10-year, below the 4% mark. The 10-year at 3.95%. So in a sense, that's obviously good for India. In terms of the rate cut cycle, it's important to mention that Bank of England kicked off that party in a sense. They've cut key interest rates to 5% from 5.25%. That 25 basis point rate cut was actually expected. Asian markets, though, are in a world of pain this morning. I mean, look at the Nikkei, 4.5% down. The Hang Seng is 2% down. So a whole host of factors, but following cues from the US market. The implied open for India is also not looking pretty. So buckle up for a rough ride this morning. Let's just pull up the implied open very quickly. 228 points down is what we are likely to open. So this is a gap down morning, undoubtedly. I'll quickly pull up the fund flows before we go into a quick global voice on what to expect. FIs were actually buying yesterday's, mild selling by DIIs. But Matt Orton is joining us now. He's Head of Advisory Solutions and Market Strategy at Raymond James Investment Management. Matt, good morning to you from where we're sitting. Of course, I think good evening for you. But just give us a sense of what is the primary concern which has changed the mood or soured the mood so dramatically.
Good morning. That's the $1 million question: is what exactly has changed based on a few pieces of data that we received one morning? And I think the answer is nothing. To me, what we're seeing is we're in summer environment, there's thin liquidity, and I think there's just a lot of question marks about, has the market maybe gone too far too fast? Is there maybe a narrative shift that's starting to take place beneath the surface? Should we be more worried about things we haven't been worried about before with respect to the economy? And to me, I think we need to see more data points. And what I look to most closely is corporate earnings. I think the market narrative is overlooking what has been a very strong corporate earnings season in the US, at least. When you look at the results, some of the Mag 7 names have offset, which should be a lot of optimism around the fact that earnings breadth is continuing to manifest itself. We finally got a rotation with respect to increasing price breadth. And I think that may have just caught some investors off guard. They may be chased, and now they're feeling the pain as well from having chased. So weak hands are just being flushed out of the market. But I caution investors against making any changes too quickly in this market environment, because to me, we don't have enough information to say that fundamentals have shifted and the underlying bullish market narrative has shifted. I don't think so. And I think we're going to have a buying opportunity at some point.
Point well taken. Nothing has changed overnight, but it does seem like for a change, what's bad for the economy is bad for stocks. And this is a lot more realistic than what we've seen from the start of 2024, where what's good for economy or bad for economy has been the opposite for equity. If we do get this rate cut end of September, do you feel like it could be a big positive for emerging markets like India? So maybe, just maybe, investors outside could start, adding to positions to Indian equity markets on expectation of a rate cut? Or do you think that's already in the price and any potential run-up from here will depend on the next rate cut?
That's a really good point. And I think what we're being reminded right now is diversification in portfolios has been beneficial. Last time we talked after the Indian elections in person, I've been bullish on India for a while. I've been encouraging a number of our clients to increase allocations to countries like India, like Japan, which, today is not a great morning for it. But overall, these have been sources of strength in the overall market, India in particular, and it's helped to offset some of the volatility we felt elsewhere. So I think this is going to be a reminder to investors that broad international diversification does actually have a place in portfolios. And to your point, seeing the rate cuts start to take place in the US should absolutely benefit certain emerging market countries. It's going to provide yet another tailwind to a differentiated growth story. And that's why, frankly, on the weakness we might get today, I'd be thinking about adding some exposure slowly to India. I'm already overweight, but I think it makes sense to use downside opportunistically because we haven't had too many bites at the apple with respect to meaningful downside outside of the election results day. And there's a differentiated growth narrative that is not susceptible or really tied into what's causing some of the jitters for investors in the US market. But I'm also not that concerned at this point about the US growth narrative either, given what I'm hearing from management teams with respect to their earnings outlooks going forward.
So the one question is, the markets were hoping that, or the bulls were hoping that a Fed rate cut cycle, when it begins, and presumptions about when it begins will actually spur risk assets further. Now, we know that is in the offing. Do you reckon that counterbalances the recession worries, and therefore the fall today, or maybe yesterday and today, maybe if it comes about, will be short-lived, or is it difficult to call?
Niraj, I think it's difficult to call what's happening because a lot of the enthusiasm with respect to rate cuts is already priced into the market. I mean, the market, frankly, I think is ahead of itself with respect to rate cut expectations. The consensus is now almost 3 rate cuts that are going to occur in the US before the end of the year. And unless we do see a much sharper deterioration with respect to growth in the US, I don't think that plays out. And with the 10-year yield crossing below 4% today, I think the market's ahead of its skis. So I do think this period of indigestion is going to last a little bit longer until the market settles on what the narrative exactly is. But I think overall, where we're probably going to settle somewhere between 2 to 3 rate cuts, hopefully a little bit closer to 2, and we're going to get more clarity at Jackson Hole. I think what we heard from Powell on Wednesday afternoon was really just the start of setting the table for September rate cuts. Options are open, and I think once we get to August, once we get to Jackson Hole, he'll be more forceful about broadcasting the start of rate cuts and what that trajectory looks like going forward. But the key is, it's not one isolated rate cut like we're getting from the BOE, like we got from the ECB. It is part of a progression of rate cuts, and I don't think they're going to be too quick to do so unless you see big changes in the data. But again, when you look at more real-time information that you're getting from corporate management teams, that you're seeing from more real-time economic data and consumer spending patterns, I'm just not seeing anything to justify the sharp moves lower that we saw today and the fear that's embedded with respect to bonds.
Well, pertinent points, Matt. Thanks so much for raising them. And yes, it is extremely difficult to call, so I won't push you to call it. But thank you so much for speaking to us today. Really appreciate your time.
Great to see you. Thanks.
Well, that's Matt Orton, of course, with his thoughts. And, frankly, I mean, the trade setup is just that. It's just extremely, extremely difficult to call the market in the current scenario. Just that the global markets will make it difficult for the bulls today. And remember, any quant indicator that you look at, if you look at quant indicators, and there are a few houses which do that, the quant indicator has been stretched for now 2.5 weeks. It is just that today they will say that, hey, we are now finally getting it right. The only question is, it's just becoming so difficult to call out tops. And because local houses are sitting on such a pile of cash, it will become very difficult to call out a bottom as well, because you never know when that money will go in and buy the large caps, which will shore up the Nifty at least, even if the broader markets were to crack a bit more. So that's the other piece. Sectorally, no point in calling. I think everything will take a bit of a stick today. Maybe defensive stand out, but IT has a bit of a positive read-through from Cognizant, and maybe, just maybe, that just fares up a little bit better than some of the others. So, Ande mein Kana Raja types might a scenario.
Yeah,
in the
we are
session
the Kana.
today.
I think.
No, IT. Well, India might be the Kana too.
I think initially to Andha as much as everyone else.
The Andha is Japan with the kind of fall that is having. The markets. Frankly,
I think
Japan.
Let's be relative here. Japan has been the best performing market so far. So they're giving up the most because they've gained the most as well. But Niraj, talking
right,
about
Samina, look at
the yen, look at the activity that's taking place there. But very quickly, in terms of trade yesterday as well, and I don't know if we've already talked about that or not, but what happened in the second half of the session? Yeah. We touched 24,000, which is what had to be done. 25,000, pardon me.
Thank God.
And the second half, it was the weakness in the broader markets. I think that sort of gave us an indication that what could come today may not be as great. And
managed to close above 25,000.
Yes, I think we'll take heart from that.
Yeah.
But this morning, I think implied Nifty indicating to a big cut, about 1% odd is what we should be opening with. Which may not look as bad as the rest of the world, but maybe 1% lower, and then the sell-off continues as we go through the day.
Yeah, plus, frankly, no big developments post-market hours yesterday on results or auto sales, which may even spur individual pockets. Aside of that Cognizant read-through,
maybe oil and gas may give some support. So that consumption could see some buying. ITC numbers weren't too bad, and consumption has been on the sell side now since budget, I think. So it was risk on trade. Maybe some buying in consumption. Yeah. IT is going to take it to the chin.
I think auto will be in focus also because you have all your auto sales data which was quite weak. In.
Yeah.
So that's going to be in focus. Some of the numbers, and one of the big numbers came in yesterday.
Yeah. Let's take us.
Just before we get to stocks, just one small piece. The Nuama note, the Nuama strategy note, summed it up really well. So just want to bring that before we get to stocks. So they say that at such valuations, Indian valuations, 5-year returns are likely to be subpar based on history, less than 5% CAGR, with risk of large drawdowns. Decelerating earnings and weakening US labor market, quote-unquote recession risks, suggest maybe an inflection point could be near. However, strong inflows make it difficult to call a top.
This is what we've been saying, right?
Yes.
The fact is that we borrowed returns from the future, so we should be having subdued returns. But the correction can only be shallow because there's so much money sitting on the sidelines, and every fund manager we've talked to, be it mutual funds, PMSs, AIFs, it seems like that money needs to come into the markets. And if the SEBI does crack down on the derivative
it made
part
no
of the market.
difference yesterday.
That money is going to go into mutual funds, you'd imagine. So it's a win-win. But a quick check on implied before I take you through the big stocks to watch this morning. I think even if the best earnings are there this morning, the reaction may not be great. So viewers, keep that in mind. That's implied Nifty. It's not looking as bad. It's down 235 points, but that is close to 1% in terms of actual calls on the index. 24,800 is what we are likely to see a start at this morning. Earnings, ITC reported. It's been the shining star since the budget. It's been an outperformer on back of no increase in sin tax on ITC. Numbers this morning may keep up to ITC's euphoria. It's been a good quarter for ITC. Revenues were up 7%, in line with what the street was expecting, in line with what the brokerages were betting on. Net profit was flat, EBITDA was flat, margins have reduced slightly, so 250 basis points, which is 2.5% lower on the margin front, but a large part of that was already factored in. Segment-wise performance, cigarette revenue was up 6.1%, FMCG and other revenues grew 6.3%, EBITDA in that segment was at 10.4%. Agri revenue remained flat for the quarter. Paper and packaging continues to see a decline for ITC in this quarter as well. EBITDA down 44.7%, but again, no surprises there because that's one vertical that has been struggling for the last many quarters. Key takeaways from the management con call: cigarette volumes have grown 2.7%. Stability in taxes enabled sustained volume recovery. They are seeing green shoots in rural recovery as well. FMCG business, though, has been facing or has faced intense competition from, of course, the unorganized sector as well. There is cost escalation on back of higher commodity prices, so inflation pressure will continue to impact margins for ITC. But the couple of brokerages that we've read this morning continue to remain optimistic on the counter with the buy. And I believe it's Nuvama that you mentioned that has a 580 rupees target on ITC. So all in all, no disappointment on the street. No major upside surprise, but there's been no disappointment on this one. The other one that we saw, which looked good to me actually, was Kalyan Jewellers. Revenue was up 26% at 5,535 crores. Net profits were up 24%, so good earnings there. EBITDA was up 16%. Margins have declined just a little bit, so flat to slightly lower on the margin front. But all in all, good earnings. Brokerages like what they see, and this one could be seeing some buying, or at least at best no selling in today's day of trade. The other big one was Tata Motors. Now remember, this one has been such a big player all through this week. Auto stocks had an exceptional run just before the auto sale numbers. Tata Motors was one of your biggest gainers. It was subdued in trade yesterday, but the numbers weren't too bad either. JLR, of course, has come to the rescue. On back of JLR sales, their profits were up 70% in the quarter. Revenues were up 5.6%. EBITDA was up 14.5%. Margins have improved as well. JLR has seen a rise. EBITDA largely in line. Their PV and CV business also looking fairly good. We will, of course, dwell on this on Editor's Cut. So largely on the face of it, good numbers from Tata Motors, ITC in line. Kalyan Jewellers is also largely in line.
Kalyan Jewellers actually a decent, very decent set of numbers. But yes, you're right, consumption is going to be one of the themes of the day. And so is IT in a sense. I'm going to start off with Infosys because remember, it was our big story just 24 hours ago that 32,000 crore rupee GST tax bill was a concern, and at the end of it, Infosys didn't do too badly. Now, what has happened in the last 24 hours is astonishing from a number of angles. One of them is the kind of industry support which came out for Infosys, statements from NASSCOM, etc. The Karnataka state GST body, which in a sense started all of this because they are the ones who gave a pre-show cause notice to Infosys, has withdrawn it. Not that the tax liability goes away, but they've withdrawn that show cause notice, and they've said now you respond to the Income Tax Department or the Director General of GST actually specifically. So you respond there for the tax demand of a little over 32,000 crore rupees. Infosys has been maintaining all along that we are not supposed to pay tax on our, offshore entities which are servicing the same clients because they're actually servicing me, the main company. So there should be no extra tax on it. They're not separate entities. So that goes through as well. And remember, there is precedence. A similar tax notice came to LTI Mindtree. They took it to court and they won. So I would say expect in a very, very dull market, maybe some positive sentiments for Infosys. Zomato could be another pocket. I mean, quarter after quarter, this company really astonishes. Their numbers came in right before close, so you saw that spike there right in the end. But more details have emerged after market closed. So I wanted to focus on that and some of what the brokerage notes are saying. District is going to be interesting to see how the street responds to it. So a few years ago, they had a Blinkit come in specifically for deliveries at home. They're now launching a separate entity, but of course under the Zomato umbrella, called District, which is going to focus on going out. So a competition for a player like, say, Book My Show, etc. Tricky space, but they're building that one-stop destination. Overall, the numbers have definitely been good. Management guidance is for 20% plus growth in the short term in food delivery. Profitability has been good. I'm just going to take you through what some of the brokerages are saying. So Citi has rated a buy with 280 as a target price. That's a 17% upside. They say Zomato is their top India internet pick, focusing on growth and top-notch execution. Yet another stellar quarter beating estimates. Nuvama has maintained a buy with a 285 rupee target price. They say it continues to deliver, Zomato continues to deliver on its promise of strong growth, improvement in profitability working in favor, and management is not dialing down on growth ambitions. MK is also quite positive. They've maintained a buy with a target price of 270. They say you're seeing a broad-based, healthy growth across segments. There is softness in food delivery contribution management, but margins, but the management is expecting a 30% CAGR in the next 5 years. Most of the dark stores, remember Blinkit is also opening more dark stores. So I think you might see a further upside in a Zomato. And, we've been speaking about consumption all day, all morning. So let's bring in Dabur as well. In a market like this, defensives could be in focus and FMCG players in line with them. So Dabur numbers largely in line with expectations. Margins have improved slightly. But I think the big highlight really is that once again you have rural outpacing urban growth. And that's, think about it, that's one consistent sort of sound you're hearing from this kind of companies or from FMCG players, that rural is outpacing urban. So if I look at what MK is saying about it, they've maintained a buy with a target price of 750. They say that they expect better mix to help enhance margins, and rural continues to grow faster than urban. They also say that Dabur is a preferred pick in the sector because of its diversified portfolio and better execution. Nuvama thinks that the strong winter and healthcare performance will be seen in Q3 because of La Nina. So you're going to have maybe a colder winter. Heat waves have dragged the beverage segment, but their quick commerce margins are also getting better. They've also retained a buy with a target price of 760. Remember, if there's a rural recovery, according to Nuvama, Dabur will be a good beneficiary of this. So that's another one I would watch. A lot of stories, at least some glimmers of hope in the consumption space.
Yeah, I mean, the stock reacted a bit to those numbers yesterday, but the brokerage views have been very, very great, including Nomura, which has raised the target from 680 to 750 on Dabur. So the brokerage reaction certainly positive. Maybe some more here. Okay, very quickly, 3 bad numbers. So Godrej Agrovet actually mixed there because revenues were lower, but margins were higher than estimated. So watch out for Godrej Agrovet. May see a bit of a reaction on the lower revenue number. Similarly for a Thermax, because both Q1 revenue and profit after tax were below estimates. Margins were flat. The stock was in the green yesterday, but let's see if there's a bit of a correction in that one today. And a bit of a howler from Triveni Engineering because revenues may have been up 7%, but PAT was down 54% for Triveni, with margins really cracking badly. So do watch out for Triveni Engineering in the session today as well. That's one more stock that could react. So, 3 pieces of bad news per se. And unfortunately, there are more, but these are the first 3.
Yeah, there's also RailTel. I don't know if either of you reported on RailTel. Again, reported a 25% year-on-year jump in net profit. So the numbers on profitability were not so bad. and it's posted revenue increase of 19.5%, but margins on Railtel came in softer than what the street was expecting. So on top line, good earnings, but margins under pressure. The stock more than likely will get a negative opening in early trade. You've also got a bunch of QIPs, but just before that, any more earnings that you two want to talk about?
No,
I think Surya, though.
I just not earnings. I wanted to come to the auto sales numbers, but yeah, whenever you're
just very quickly, earnings. GR Infra was the other one. Very weak numbers. Revenues were down 18%. PAT down 49%. Margins cracked. So GR Infra is the other one which will react negatively. And Indegene, we need to give some positive news. Indegene was great numbers. Revenues up 11%, but margins 19.1 versus 15.9.
Actually, you're right. There's been no serious significant outperformance this morning on any of those broader market
except
earnings.
for a small, like I said, Indegene, which has done well, so may do
The
well.
two very quick QIPs that are happening. Newtep Technologies, we believe the promoters are looking to actually stake sales there, looking at block deals. This is coming at a discount of about 3.5% to current closing price yesterday. And you've also got Morpin Laboratories. Again, there is a QIP here where they're looking to raise about 200 odd crores at a current price, at a price of 9.2% discount, which is to yesterday's closing price. So watch out for Morpin Laboratories and Newtep Technologies, both of those on deals in early trade this morning. This is what some of the wires have reported this morning. So all in all, earnings largely in line, no major beat except the one that Niraj mentioned. Sentiment is weak, currency will open lower. It's going to be a tough Friday morning for all of us.
Just wanted to add the auto sales numbers, which are unfortunately not that positive either. So Maruti stellar quarterly numbers, but for July their total sales are down 4%. Domestic sales are down 5%. Eicher Motors has seen motorcycle sales down 8%. Their commercial vehicle sales are good though, up 13%. And international motorcycle sales for Eicher are down 14%. Hero MotoCorp also has seen a downtick in total sales, 5.4%, and domestic sales at 6.4%. So July has been a tough month for the auto sector, and I believe we'll be discussing auto in more detail on the editor's cut as well.
Yeah, in fact, I'm looking forward to that because, Agam is known to track autos for a really long time, and Tushar tracks autos like nobody else. So, Agam, looking forward to what you have on editor's cut today.
Yeah, and we actually do have a very interesting conversation going on as well. So, we have the first quarter numbers for a majority of these passenger vehicle majors. And what's really standing out is that while revenues have been, so-so, we've seen a considerable expansion in operating margins. But Maruti, in this case, when it comes to expansion in operating margins, is making its mark in several different ways, which is why Tushar and I are going to try and decipher as to what's really happening and what kind of change in trends are we in fact looking at. So, Tushar, let's start off with exactly that. A big improvement in margins for all these passenger vehicle companies. But why is it that Maruti is standing out as compared to Tamo or Mahindra?
So essentially, Agam, it's finally the SUV playing out for Maruti Suzuki at this point of time. Remember, a year and a half ago, or up to 2 years ago, Maruti Suzuki was not anywhere in the SUV space. The Grand Vitara did not exist, whereas Mahindra and Tata Motors were running away with the market share when the SUV drive was coming in the Indian market after the pandemic. People were buying bigger cars, but Maruti didn't have those cars. Right. So people were buying the Tata Nexon, people were buying the Scorpio, people were liking the XUV 700. Right. Maruti didn't have. Then they brought in the Grand Vitara. They bought in the Fronx, which is also a compact SUV. Right. The Brezza was updated, and all those numbers are now finally showing in the company's financials. So year on year, the EBITDA has gone up for Maruti Suzuki about 50.9%. The margin has expanded from 9.2% to 12.7%. That's a 350 basis point jump in just 1 year. So that SUV play, that premiumization is coming in. So while there may not be volumes as such in the first quarter, there was a 1% decline in domestic volumes, but the money is still being made. So less volumes, but still more money being made. That's pointing to actually premiumization that we have been talking about.
Right. So Tushar, we were talking about some numbers when it comes to market share as well, and those numbers have even surprised me to a certain extent. How are they looking?
So essentially, Maruti is given it's the biggest car maker in India. So their volumes are in the SUV space specifically. They are the largest SUV maker in India in terms of shipments, as in number of volumes.
Sure.
They're not making as much money on them so far because remember, it's primarily a small car company.
Right.
So the average selling price for Maruti is still at about 6.5 lakh rupees.
Right.
As compared to a Mahindra, which makes about 15 lakh rupees on every, 15 lakh rupees is the average price actually of every SUV that Mahindra sells.
Right.
So Mahindra enjoys the numero uno position in terms of revenue market share.
Right.
Number one company in that sense.
Yes.
Maruti ships the most number of SUVs,
Yeah.
Grand Vitara, etc. But Tata Motors makes the best-selling SUVs in India, that is the Punch as well as the Nexon. So you see all the three players, the listed players, have split the SUV market amongst themselves in various parameters, so to speak.
Right. So at the moment, what is the SUV market looking like? What sort of models are we watching out for, and what models could potentially dominate sales over the next 3 to 4 quarters?
So essentially, where Maruti will lag now is that it does not have SUV coming up in FY25 at least.
Right.
Whereas Mahindra and Tata both have new SUVs coming in. Tata Curve will be launched on the 7th of August and the Thar 5-door version will be launched on the 15th of August.
Sure.
Both the companies are stepping up volumes, have retained focus on SUVs. About 70% or 75% of Tata Motors' volumes comes from SUVs.
Right.
Mahindra's is a pure SUV company.
Sure, absolutely.
So essentially, since there's a lack of a new model coming not there from Maruti, may impact its market share going ahead in the SUV segment.
Right.
But we also have to remember that in the final quarter, final quarter of FY25, that's January to March, Maruti may have an electric vehicle coming in, which will be the compact SUV space itself.
Right.
So that benefit will come in. Remember, that's important because Tata Motors is still selling about 16,600 EVs on a quarterly basis.
Right.
That's about 12% of its overall volumes.
Right.
So both again, Nexon EV is the best-selling, Punch EV is again the best-selling, about 75% market share.
Yeah.
So that's where Maruti can actually eat into those numbers, and we can see some uptick in the final quarter, maybe on the back of the electric SUV that Maruti is going to launch.
And actually, I was also a bit surprised with the kind of traction that models like the Brezza and the Grand Vitara are actually getting. I reckon that it would be pertinent if we also include the role of Hyundai in this particular market.
Absolutely.
How is that panning out?
That's actually very significant. The Hyundai's role is very significant because sometime later this year, the company will list in India.
Yes.
Remember, it's the company that created the compact SUV segment in India with the Creta, the 15 to 20 lakh bracket, which is a sweet spot, so to speak, when you want to sell and as well as make money. 15 to 20 lakh is the bracket.
Yes.
Creta was created by it. 65 to 70, I think 65% of Hyundai's volumes are still also coming from SUVs.
Right.
The margins are also healthy as far as the DRHP that we saw, comparable to that of Mahindra and that of Tata Motors.
Right.
So essentially, that's again, you can say like a joke in the pack or so when it comes in lists later this year.
Sure.
So there's something that investors will have to look out for as a fourth car maker or SUV maker in the mix.
Yeah, absolutely. And of course, and all these four are major automakers, and I'm sure that they're going to do all that they can to remain competitive in these markets. Just a final point then, Tushar, pricing is going to be important, and I understand that there's going to be a big distinction between EVs and non-EVs. Still, what is the lay of the land in this case?
In terms of just SUVs, what Maruti at this point of time needs actually is a car which sits in the 11 to 15 lakh bracket.
Right.
It already has 15 to 20 lakh in the Grand Vitara.
Right.
So apart from just the Brezza, which is still in a lower level, about 7 to 10 lakhs, competes largely with, we can say, with the lines of the Punch as well. It needs something which is a bit above Punch and sits in the 11 to 15 lakh bracket.
Right.
The average selling price of a car in India is about 11 lakh rupees at this point of time.
Absolutely.
So somebody who doesn't want a Brezza, but is not going for a Grand Vitara, which may be 20 lakhs and above, something in between should come in. Yes, there is the Fronx, but the volumes are significantly higher, but it needs one more product to actually capture the entire space.
Right.
In terms of Tata Motors, the Curve is a good bet against the Creta, good challenger to Creta, because Tata did not have that so far.
Right.
It has the Nexon and the Punch between 7 to 15 lakhs, and then on the higher end, Harrier and Safari, 15 to 20 lakhs, they will need the Curve that will fit in at that point at that price bracket.
Right.
Mahindra has its bases covered all over. The only problem that Mahindra faces at this point of time is stepping up the production and matching the bookings, the outstanding bookings that the company has going ahead. It's still sitting on about, I think, 1.5 lakh units order book.
Right.
The waiting periods are still at about 8 to 10 months for some models. There is some price rationalization. The company is also talking about variant rationalization. So they are trying to bring down the price a bit lower. Towards the 15 lakh bracket. So they are looking, in a sense, to get that buyer who's in the 15 to 20 lakh bracket, not essentially going above 20 lakhs to get those more expensive consumers.
Yes. All right, well, there you have it. That's how things are shaping up for the SUV market. Tushar, thank you so much for joining us and, taking us through how things could potentially change for the SUV market, India's SUV market, over the next few months and many quarters as well. Well, with that, we shift, pardon me, of course, we're going to shift gears for sure, but we're also going to put the spotlight on the futures and options space as we move into a break. Back in just a bit. Welcome back. This is the India Market Open. Let's take stock of the futures and options space. Let's see how things are faring here. Now, yesterday was a day where we saw the Nifty move above 25,000, close around there. And, bulls will certainly be happy. But we also have certain global cues which are actually weighing down on the indices this morning. And we potentially could see some weakness, at least in open. But, yesterday we did see the Nifty advance by about 0.25%. There was a lot of increase in open interest as well when it comes to the August futures, about 2% added there. The Bank Nifty as well is where we did see it, move largely flattish, but the open interest did increase by around 3.5% as well. In terms of the options market, things are becoming a little bit more interesting. And yesterday we saw 25,000 as the mark which establishes itself as with a lot of open interest with respect to calls as well as puts, as you can see here. I'd reckon that this may not necessarily be a level of support, but it'll be an important level around which the Nifty could potentially move over the course of the next few weeks and days. Well, of course, on the higher end, we're now starting to see a little bit more accumulation around the 25,500 call, and this potentially could also act as a near-term, well, I would say resistance on the lower end, keeping an eye on 24,500 as well. Let's move on and talk about stocks now. That's where things have been a little bit more volatile. We've seen shorts in Birlasoft and India Mart along with GNFC among stocks which are unwinding. Let's pull that list up as well. Short covering for TVS Motor Company, Granules and Maruti Suzuki. All in all, a mixed day of trade for sure. Even though the Nifty made that milestone, the question really is that what are we doing with the Nifty now? Well, let's get an expert opinion. We have Rahul Ghosh of Hedge.in who's joining us on the show. Rahul, good morning. Thanks for joining in. Well, Nifty has made that new milestone now, but what's the way forward? Do we still see resistance around the higher levels at this point in time? Because while there is a little bit of fatigue setting in, the price action is perhaps perplexing at this point in time.
Good morning, Adam, and thank you for having me. So last week around when Nifty was around 24,500 odd, we had mentioned that the upside is very limited and the downside has more chances. However, markets did rally another 400-500 points, much to our surprise. But we continue to maintain our view that at least in the first few weeks of August, we would see a downtake that would take markets below the 24,400 mark, which is still about 400 points more considering today's gap of 200 points in the opening. So we maintain that view that below 24,400, you will see one bout, at least in the month of August. So people holding bearish positions for the month of August can continue to do so. And like you rightly said, that slightly perplexing the last leg of the rally, it came as a gush around 24,800. It was constantly facing resistance. It broke out, but then today again, you see it's not able to sustain and coming back below that level. That's why keeping the little bit bearish stance in mind, we're planning a bearish to neutral strategy for the month of August.
So what is that bearish to neutral strategy going forward?
So firstly, last week round, we planned a calendar bear put spread where we bought August and we sold September. Users holding that strategy should continue to do so because, like I mentioned, we do expect one round of selling to come about in August, or they can pivot to the current strategy. That is, they can exit those legs. It's in a very minor loss and can move to these legs, or can continue to hold that and take this fresh as well. Both cases are absolutely fine. What we're doing here is we're taking a simple bear put spread where we're buying the 24,500 August end and we are selling the 24,200 August end. These are the first two legs of the strategy and a simple bear put spread. But what we're doing, we're trying to hedge ourselves against if Nifty does not move down and our view does not play out. But we want to hedge ourselves in a way that we don't get perturbed in case there is a sharp down move to 24,000, which is a very real possibility at this point in time. So to hedge that risk, we are selling September end 23,200. And of course, to hedge that sold leg, we're buying the 23,200 of August. This does two things. One, if Nifty goes below 24,400, which we expect, it would yield handsome profits because the August legs would rise owing to the current month IB. If there is no fall and our view does not play out, the September far away leg will ensure that the extra premium paid in the 24,500 gets compensated.
Okay, all right. Perhaps I can go ahead and re-explain what Rahul has suggested. Firstly, he is deploying in a bear put spread in which he is buying the August 24,500 put, and against that he's also selling the 24,200 put. But well, he's adding two more legs to this particular option structure, and what he's doing is he's selling the September 23,200 put, and to hedge this specific short option, he's also going ahead and buying the August 23,200 put as well, which plays a little bit like a calendar here as well. Rahul, very quickly, in terms of maximum risk and maximum reward, can you give us this equation as well?
Sure. So it's basically a combination between a bear put and a bull put. The bull put basically protects you, or a calendar bull put, like you rightly said. The calendar bull put protects you in case markets don't go down, which is the preferred direction currently as per us. The maximum risk comes about from the perspective that if you look at the credit you're getting, the debit is about 145 odd points today, taking yesterday's closing. It might go up when markets open. So if I take 145 rupees as the current debit and 90 rupees as the sold debit, and further we have another 60, 70 rupees in the September. The 60, 70 rupees of September is not going to erode fully. It's very important to understand that because it's a far month expiry. That can erode only about 30, 40 points. Plus, you might lose about 10 odd points in the August leg that you bought to compensate for it. So keeping that structure in mind and keeping that IV might rise a little bit in a down move or not rise at all if the down move does not happen, we've come up with the 1200 rupees risk purely from the Nifty debit perspective. The reward is fairly simple because if markets go down between 24,500 and 24,200, there's that much delta you can make, minus the sold call, which will definitely go up a little bit as well.
Fair enough. Okay, Rahul, we'll leave it at that. Thank you so much for joining us and taking us through that option strategy, an interesting one as well. We're for now playing with a little bit of a negative bias as far as the Nifty is concerned. Well, with that, it's back to you all.
It looks like it's going to be a tough morning, but of course strategies are always rolling in either on the long or short side. A quick check on implied Nifty before we introduce our guest and gear up for trade this morning. That's implied Nifty indicating to a 227 downtick in early trade. So 24,800 is where we're likely to start this morning. Kush Bora joins in now, Avinash Gorashekhar, to talk to us about a fundamental and technical view on the markets. Kush, we've been talking about this extensively. Take profits at higher levels. Don't get too aggressive on higher levels. At a start of 24,800 on the Nifty this morning, would you consider initiating a trading strategy at all for the August series?
Hi, morning, Samina. Well, you're right. We've been talking about it, but the markets have, done their own thing. We've not seen a meaningful correction. Is this the start of one, very difficult to tell with the kind of moves that we've seen off late? To your question, do we initiate a buy position just yet? Well, the immediate support for the Nifty is actually at 24,800. So I'll actually wait. If this support is breached, then you're looking at the first, or rather the next level, which is the 20-day moving average of 24,500, 24,550. So from that perspective, I think I'll wait and watch, not initiate a long position on the Nifty just yet. Bank Nifty, however, you could go ahead and initiate a short position. There has been that pressure of 52,000 acting up. The near-term support being at 50,800. Once that is taken out, you're looking at the 50,000. So rather than the Nifty, I'm actually focused on Bank Nifty, where the trend seems to be slightly surer, slightly clearer.
All right, Avinash also with us. Avinash, very good morning to you on a morning that's looking tough for sure. What would be your opening strategy where we're in all likelihood going to open gap down?
Yeah, good morning, Tamanna. I think, I think markets are going to be volatile. I think the geopolitical, situation has got a little, bad, and that is the reason the markets have corrected. My sense is that, I think this could be a temporary kind of sell-off. I don't think Indian markets are going to see a relentless kind of sell-off. There could be a little bit of selling in the first half. In the second half, hopefully, as things stand, obviously one will have to see how global developments happen. And in the near term, after the Nifty touching 25,000, I think a little bit of profit booking was anticipated. So I think, one needs to be very careful in your stock selection. And I think even as of now, as the corporate numbers are coming out, I think there could be good, value buying opportunities. It's only a matter of time, Tamanna, when all these things get normal. And I think market should again focus on earnings. So for the very short term, I think we have been advising our investors to stay put. I think there's no need to hurry because probably the markets could see lower levels of say 24,500, 24,600, and that could be a good area to actually start nibbling. I think we are positive on sectors like cement, auto components, typically real estate, capital goods, housing finance. So I think these are good bets, but I think it's better to wait for a while, I think, before you take your call.
Kush, very quickly, your top trading strategies this morning. What are you recommending? Anything stock specific?
Sure, it's a mix of long and short. Himadri specialty chemicals. This is one stock that we discussed yesterday during the closing show as well in the last minute. So I think this is one trade that can be looked at this morning as well. 465, 480 are the targets. 430 is where you place your stop loss. on the short side, Exide hasn't really been doing all that well. It's broken the key support zones. The 20-day moving average was taken out 2 days ago. 50-day moving average also has been taken out. So I think from a near-term perspective, this pressure could maintain. 500, 485 are the targets to look at on the downside. 525 is where you place your stop loss.
All right. So what are the stocks that you should look at this morning? Because it's going to be a very stock-specific kind of a morning, definitely. Some key stocks to watch and trade. Anushi joins in with the details. Yes, Anushi.
Right, Tamanna. So the first one on the list is Kalyan Jewellers. The company came out with its Q1 results over here, and we are seeing a revenue growth of about 26.5%, but this was still below the Bloomberg estimates of 5,558 crore. Now, if you look at the EBITDA and the EBITDA margins, they majorly remained in line with what the consensus was. So the EBITDA margin was about 6.8%, while net profit saw about 24% growth. Now, in other key highlights, also the company added about 13 new stores in this quarter, while if you look at its same-store sales growth metric, that was about 13% in the South Indian markets, while in the non-South Indian markets, the growth was about 11%. Moving on to Thermax now, so the revenue was about 13% here. Again, the numbers that we are looking at are below expectations. EBITDA was a 7% growth, while margins were about 6.5% compared to 6.8%. Now, this is because of the industrial infra segment also that we are looking at. But other than that, net profit we are seeing about 82% jump. But do note that this is on the account of lower base of last year, wherein they faced a litigation charge of 51 crore and the other income moving up by about 58% in fact. Then is GR Infra Projects. Here the revenue was down about 18.1%, while EBITDA was down about 39.4%, which led to a margin contraction at 18.1% as compared to 24.5%. And if you talk about the non-earnings side, we have Aurobindo Pharma in focus, with the company's buyback worth about 750 crore is opening on August 5th and will close on August 9th. So this is a buyback for about 51.37 lakh shares, which represents about 0.88% of the paid up capital. Now, again, the buyback price is going to happen at a price of 1,460, which is a 1.88% premium as compared to its yesterday's closing price. Do note that this is the first ever buyback the company has declared in July 24. So these are the four stocks that should be in focus and trade today.
All right. Thank you for that, Anushi. So those are some that you should definitely watch out for. I don't know how much, those numbers are really going to help. Even quarterly numbers are going to help in a morning like this. But Kush, let's come to some of those. Let's start with Kalyan Jewellers. Numbers seem good on the face of it. Do you think enough steam there to see some action on the charts?
Well, the stock was consolidating already in the last 5 to 7 sessions with a mild negative bias. So not sure, if this will really impact. I think, the broad range, once that is taken out, the stock could move. So the broad range for this one is 560, 555 on the downside. And on the upside, you're looking at a 580. So if the range is taken out, then perhaps, you could see a directional move. But up until then, I think, this consolidation might continue. Anyway, the stock had a very, very sharp run in the last 3 months.
All right, Avinash, let's just talk about one more space which is going to be in focus, and let's look at some of the auto companies coming in. So the numbers are out in terms of their earnings, but you also have sales numbers out for July, which leave a lot to be desired. Do you see some pressure in the auto space today, Avinash? And all things considered, what would be your pecking order now?
No, I think clearly within the auto space, July numbers have not been very great. In fact, if you talk about Tata Motors, the management has given a little cautious guidance. At the same time, July numbers have been not as good as what the street expected. But I think overall results have been in line. So I think probably, in the auto sector for the next couple of months, if volume growth is muted or it shows negative growth, I think we would be a little cautious. But I think within the pecking order, I think Mahindra and Mahindra, Tata Motors, and then Maruti, these would be our pecking order picks. And we still continue to be long-term positive on these companies. We believe that, probably the second half of FY25 should be significantly better. There's been a lot of inventory destocking. I think supply constraints which earlier were present have now gone. So obviously, pricing power has got limited with these players. But I think overall, as long as, the macro economy does well, commercial vehicles, passenger car, I think the near-term bet would be the two-wheeler segment, Tamanna, because their volumes have been pretty solid. We have seen good numbers from both Hero Motor as well as Bajaj Auto. So I think net we have a neutral call, but yes, I think any decline in this kind of market would be a good opportunity to accumulate.
Sure. Two earnings reaction that we're anticipating today is ITC and also Tata Motors. ITC earnings largely in line. The stock has been doing quite well since the budget, being kept out in terms of increase in sin tax has worked for ITC technically. Sub 500, would you consider going long on ITC? And also, what's the call on Tata Motors? Of course, made record levels only a few days ago.
Samina, that's a question for me.
Yes, Kush.
Sure. ITC, my theory is that, you should have a portfolio for all seasons. And from that theory, ITC will fit in because, you also need a margin of safety. And that is what something, ITC gives to you. While the stock has been consolidating, any kind of, a negative bias, might not get one. But, if there is any kind of negative bias and if you do get somewhere close to 470, 480 also, even till that level, it's a very good, entry. For me, ITC, as I said, from a medium to a long-term perspective is also a buy and hold. On the upside, you could be looking at the 525 plus kind of levels in the coming months. So on the whole, very constructive on ITC, as I said, not only from a gains perspective, but also from a margin of safety perspective. So that's one stock that you should add, if you end up getting any kind of a dip. Tata Motors, the structure is extremely encouraging, especially if you move to the weekly setup. The 1200 level, 1225 level is very much in play. It's just that for the near term, the stocks actually run up quite sharply. So it will be prudent to buy on dip. So any dip towards those 1100, 1120 levels should be taken as an opportunity to buy. As I said, the structure is very bullish. It's just that in the near term, it's run up a bit. So any kind of profit booking should be taken as an opportunity to enter afresh.
Right. Avinash, you want to comment on this one? How did you view Tata Motors and ITC? Do you feel like either of those stocks are worth an upgrade, or would you consider adding positions to these stocks?
I think in the short term, Tata Motors may remain a little range bound and weak because the commentary from the management on the future growth outlook has been quite disappointing. I think the markets were not very happy with the outlook shared by the management. Although numbers have been much better than what the street expected. And I think clearly JLR has done well. EBITDA margins have improved. But I think going forward now, clearly, I think in the next few months, if growth gets muted, specifically for the JLR business, then I think that's a matter of concern. So we would be a little cautious on Tata Motors. As far as ITC is concerned, I think it's a very natural, hedge in a weak market like this. It won't go down significantly. It won't go up, very fast. And I think numbers have been in line. I think markets are not expecting any major fireworks from ITC. I think although the volume growth, is likely to, obviously get better in the second half. So I think as a strategy, I think it's better to, accumulate ITC if it corrects at all. Tata Motors we would avoid, as of now.
Very short break, right in time for the pre-open rates. It's going to be a tough morning. The implied open is showing all the indications of quite a tough morning. What should be your strategy on a morning like this? We come back with all of that and more. Stay tuned.
right, back with India Market Open right here on NDTV Profit. Some fairly interesting data that is coming out on individual pockets. So, before I get to our guests, for Zomato, and I know that the implied open, of course, suggests downtick for Zomato. Blinkit is actually now 23% of revenues already, up from 15% earlier. It's growing at a breakneck pace, and I think that is probably one more reason why Zomato has nudged life-wise yesterday. It's a 2 lakh crore market cap company, which is growing at the rate of knots or maybe more than that. So quite something really, what's happening out there in Zomato. Beyond that, there will be largely a bit of a pullback, less than 1% or just about there, but there'll be a bit of a pullback that we'll see in markets at large. The question is, what pockets withstand this pressure more, what pockets fall more? Now, Kush, some buckets of strength some buckets of weakness in yesterday's session. Let's start off with that. After a really strong rally, yesterday all the wind power companies, equipment companies came off. Suzlon, Inox, some of the others in that renewable energy space, all of them came off. Are the charts showing more weakness because they will start off lower today? So with that assumption, can there be more downsides into these names?
Niraj, I think I remember, we've had this conversation about a week, maybe a little, a little longer than that, not too far back. But then the idea was to hold on to these because, the strength was inherent despite the kind of moves that we saw. Now, if you see, some of these were showing slight topping out formations, and not in terms of the fact that, the upside is over. It's just that, some of them had run up, a little too much, little too fast, and then perhaps some, with waning momentum. All in all, what they're showing right now is that what we've seen in the last day or two is more of a profit booking rather than anything else. So I will actually be, constructive on these names. Once they come close to those support levels, I would actually look for an entry point. So for, let's say, an Inox Wind, that level comes to 170, 172 thereabouts. So, any kind of dip towards that should give you a good entry point, a good risk-reward ratio. Suzlon, a bit of a volatile counter. The dip comes, or rather the entry point comes in at 64, 65 kind of zones. Anywhere close to that, you could consider, a re-entry in some of these names partially or, in a staggered manner, if not fully. So I don't think the story is quite over, even in terms of the price action. It's just that, we saw a round of profit booking, and perhaps on dips, they'll be, a good, they'll still be good buys.
Okay. So that's as far as some of these wind power companies go. Now, two results that, and by the way, the pre-open rates have opened, and I think we'll probably see some bit of downtick in the session today. Just keep in mind that this is actually the kind of start that we might see, 0.6, 0.7%, or maybe slightly more than that. So that's to be kept in mind. From results that came out, Avinash, there is Titan today. Kalyan Jewellers numbers that came out were largely in line, but brokerages have rolled forward the earning multiple and the month for which they value the company, and therefore the target prices have been raised. But what did you make of the numbers, and can Titan do something different than what Kalyan has done? Because the last 2 or 3 quarters, Kalyan has been a rank outperformer and Titan hasn't.
I think, Niraj, you're right. Markets are expecting that Titan could show a better kind of top line as well as profitability number. And I think clearly in terms of the size, in terms of the reach, in terms of the pricing power, Titan is a much significantly large player in the jewelry space. My sense is, I think the commentary given last time was quite encouraging. We'll have to see how the numbers stack up. But definitely, at the current odd level, my sense is I think the numbers could be slightly better than what Kalyan have reported. Markets were expecting a little better number from Kalyan in terms of top line and margins improvement. But I think probably, the markets were not very happy with the numbers. But Titan possibly could surprise on the jewelry side. And most importantly, the market has also grown quite significantly. So the market leader like Titan could possibly get a better rub-off. We'll have to wait for the numbers, Niraj, but I think clearly once the numbers are out, the management commentary is out, I think you could probably see a little more uptick from the current.
Kush, how would you, if metals see some weakness in trade this morning, which is largely expected, would you treat it as a buying opportunity to initiate long trades on any of those metal counters? Because it seems like they've been gaining on expectation of the rate cut up until yesterday at least.
lot of these metal names for a while now. While you're right, in the last 8 odd sessions, 10 odd sessions, some of these names have run up. Even come close to the resistance zones, which is, let's say, for example, a Jindal Steel or a Tata Steel. They've somehow managed to hold up around the 20-day moving average, but haven't really closed above them. So for me, the pressure continues unless some of the higher resistance levels are taken out. I'll actually look at some of these names as a shorting opportunity, depending on each stock. How big a dent there is this morning. These might just perhaps be a shorting opportunity. As I said, near-term trend has just turned positive for the last 8-10 sessions, but not entirely convincing that we're out of the woods and you could actually go long on some of these names.
All right, let's look at one stock which, at least in the pre-open session, seems like it's doing fine. A couple of them actually. Kalyan Jewellers not faring too badly on the back of its numbers. We spoke briefly about Kalyan Jewellers before we got into the pre-open session. Zomato also faring decently after its numbers. Remember, they came in at close. Some excitement about a new vertical. They're starting a new app called District. Avinash, just wanted a take from you on Zomato. I mean, obviously, Blinkit has worked for them. Question is, will a going out app like District also work in?
I think it all depends on the kind of scalability and this app proves for Zomato. Tamanna, I think clearly the markets have given it something kind of re-rating because this space attracts very little competition. There are just 2 companies in the food delivery app space, and I think that is the biggest moat which Zomato enjoys. And I remember when Blinkit was launched, a lot of people were skeptical whether it could actually be a good positioning for the company. But I think looking at the consumer trends in the country, I think this has actually been very smartly done by the company. So I think this also being a new initiative, it would obviously have a little bit of skeptical reactions initially. But I think as a business grows and as the objective is realized, I think you could possibly see the results of this app in the next, say, 6 months. So it's difficult to give a call as of now. But yes, I think anything innovative and which can actually generate the volumes and the business for Zomato is definitely a welcome call.
Execution will be key, but the base numbers also looking very robust. Kush, on the charts, what is Zomato looking like for you? A lot of upgrades and a lot of positive commentary actually from brokerages this morning.
Very strong. In fact, if you look at the weekly setup, it's been practically a one-way ride from those 45 levels. Even now, there's been some profit taking, and that's actually been a healthy thing where traders, investors got a chance to accumulate at a slightly lower level. For me, this is a buy at the current juncture. Also, any kind of pullback, up until 220 should also be considered as a buying opportunity. So on the whole, the setup is very encouraging. I won't be surprised to see the stock close to those 260, 275 levels also in the coming months. So all in all, a very good setup. Any kind of dip should be taken as an opportunity to add further or initiate a fresh buy.
A quick one on OMCs. With the way crude has moved in overnight trading across Asia, do you feel like HPCL, BPCL, IOC could maybe be an intraday positive move and hence a long call on them?
Well, the near-term structure is actually suggesting profit booking. And we've discussed this time and again that these stocks are not the ones that you'd want to hold and roll over. I understand the immediate impact of crude might perhaps just give that fillip, but some of these are looking at those near-term highs. So for an IOC, 180, 185 is the zone where profit booking has set in. For an HPCL, 400, 405 is the level where we've seen profit booking set in. So the risk-reward ratio does not really favor. So I would wait out, a fresh entry in the OMCs.
Okay. The other stock in focus, and Harsh is going to be bringing out a brokerage note on Adani Enterprises. But just before we do that, Adani Energy Solutions today is a bit quiet, but yesterday had a big bump up. My guess is because of the nature of the investors that came into the QIP. Now, I just want to make a standard disclosure that Adani Energy is a part of the Adani Group and you're watching NDTV Profit, and NDTV is a part of the Adani Group as well. But having said that, the quality of investors which have come in to the Adani Energy QIP is is quite A-list or A+, because you have GQG, which has made tremendous gains on the original Adani investments, also a part, but the Druckenmiller family has come in. Stan Druckenmiller is a huge name in American investing, American investor and philanthropist, and that family office has also put in the money, and I think that is presumably the reason why this stock had this big bump up in trade yesterday. So watch out for this one. Today, everything may fall, but it's certainly a name that you want to keep on your radar with the marquee investors that have put in the money there. Now, Harsh, you bringing out two notes to us. Good morning. May I urge you to start with the Jefferies note on Adani Enterprises, because I was talking about Adani Energy. So start with that, and then, of course, on to the other note on Dabur.
Well, absolutely, Niraj. Let me first start off, as you said, with Adani Enterprises. 3,800 is what Jefferies has rated in terms of its target price, a 20% upside from here. Now, in terms of what's moving for it, Q1 EBITDA grew an impressive 49%. Where did the growth come from? New energy and the airport business. Now, these two businesses, in terms of just EBITDA, have grown 4.5 times on the new energy business. So EBITDA in the new energy business has grown 4.5 times year on year. And airport EBITDA has grown 33% year on year. So those two are really driving the numbers ahead for Adani Enterprises as a whole. In terms of the way Jefferies is looking at the business as a whole, they believe that Adani, through Adani Enterprises, is riding industry tailwinds of incubating new businesses. The new businesses are now contributing to 60% of Adani Enterprises' EBITDA, and there's a gradual value unlocking which is coming into play, which is likely to continue over the next few years. Of course, coming into play from a perspective that we've seen that those couple of demergers which were announced yesterday, especially on the FMCG business, Adani Wilmar, as well as the new energy business. So that plus others expected to continue. In terms of net debt, it's ballooned a little bit from 41,600 in Q4 FY24, 41,600 crore. It's ballooned to 50,200 crore at the end of Q1. 80,000 crore of capex for FY25, likely one of the reasons why that debt has ballooned. But that guidance is maintained, and that they believe is a positive. So they're looking at this more constructively from a capex perspective rather than from an increasing debt perspective. Let me switch focus. You have Dabur as well. Nomura retaining a buy on Dabur, 750 being the target price versus 680 earlier. So sharp increase there, 16% upside from here. In terms of sales, they believe that sales have inched higher, expected to get better going forward. So they're more constructive on sales. Largely a rural play, Dabur, and they believe that that rural play will, really kickstart going forward as well. That those margins will marginally improve going forward on a sequential basis, which was what even the management told us yesterday, Niraj. Also, investments in rural distribution as well as the rural portfolio is aiding better than peers rural growth is what Nomura seems to suggest. They're expecting the increased media spending in rural to aid the rural numbers even going forward. So some of those commentary on rural is excellent. And in terms of valuations, they've hiked the price to earnings to 51 times from 49 times. That's in line with the 5-year average. So constructive Nomura on Dabur.
That's a brokerage upgrade coming in on Dabur. It'd be interesting to see the stock actually reacts to that, because for now, as pre-open wraps up, the only big gainer this morning seems to be Zomato. Tata Motors, despite earnings being in line, is indicating to a gap down of 2.5% in trade. ITC, Kalyan Jewellers are some of the other ones we will be tracking closely in today's day of trade. Kush, I'm going to turn this conversation around. We've talked enough about what would you buy, long trades. Give me a short trading opportunity today, intraday. Happily.
Two of them. First is an Exide that we've already discussed. Could be considered as a short trade. 500, 485 are the targets. 525 is where you place your stop loss. The second one is a continuation from yesterday's closing show where we discussed RBL Bank. One of the weaker names in the space continues to reel under pressure. So this one can also be considered, as a shorting trade. 225, 219 are the near-term targets. The opening perhaps might be closer to the first target, so you could still play in for 219, 218 kind of levels, and 237 is where you place your stop loss. So Exide Industries and RBL Bank are a couple of names that are weak and could see perhaps some more down move, especially given the kind of the sentiment that markets are seeing there.
So, all right, those are the intraday sort of calls you could take. Avinash, if there is one top call I was to ask you right before we get into the session, the markets open session.
Yeah, Tamanna, I think yesterday, a company called Electro Steel Castings has declared its Q1 numbers. The company is one of the leading DI pipe manufacturers, which have applications in sewerage and water applications. We have seen a 20% growth in top line and a 100% growth in EBITDA. EBITDA is close to about almost 350 crores from 160 crores in Q1. And the profit has jumped from 75 crores to 225 crores. So I think, in terms of order book, they still have an order book of 7,000 crores. And last year, the revenue was 7,500 crores. The bottom line was 740 crores. So extremely value-wise, looks pretty cheap. I would suggest that, if one can hold on for the next, say, 6 to 12 months, price target of at least 250, 265 looks very much possible. So water is a very interesting theme. And I think here we're getting a market leader at a very extremely value proposition, which I think investors should actually capitalize in these kind of markets.
Okay. Well, Avinash, I will ask you post the market open about whether Electro Steel is the only play within that segment, or do you like something else as well? Because you're right, it's a very interesting theme. But brace for a bit of a pullback on open today, viewers. The pre-open has shown its hand. Global markets are weak. We are likely to start off lower. The question is, will we go down further, or will this dip be bought into? It will certainly be put to test. The buy the dip theory will be put to test, though maybe one day is not enough to test it. Let it fall for a bit if it does, and then we decide. But 1% lower for the Nifty. The Bank Nifty too, close to 1% odd lower in trade. Mid caps and small caps should come on your screen. Others showing a bigger corrective move. 1.3% for the mid cap space, and the small cap space will come up on your screen as well. About up 1.3%. So red letter day, advanced decline negative. Let's get the heat map up on the screen. Very little green. Yep, handful of stocks, 3 or 4 of them. And IT out there. This may not be as much a cognizant piece as it is that just the market wants to be on defensives, because you see Apollo, HUL, Reddy's, Nestle, Infi. That sums up the defensive bent of the Indian market today, and not all of them are green, by the way. But look at the red. Red reaction to Tata Motors. Numbers just in line, but I think also the market forces have to do something with it. Plus the monthly sales numbers, because Maruti 2 is down about 3.5. Metals take a bit on the chin today. Is it the worry of global slowdown which is pulling the metal stocks lower, or just otherwise? But Tata Steel is down in trade. There is weakness in JSW Steel as well. Adani Twins in the top 10 losers. ONGC is down in trade today as well. I wonder if BPCL is in the green, but I don't see in the top 15 or 20 names. So that's to be kept in mind as well. All in all, a lot of red, almost everything falling down. Maybe broader markets have better stock-specific moves, Tamanna.
Yeah, maybe, but I was just noticing how, Niraj, the 25,000 excitement, which was just 24 hours ago, seems like a distant memory right now. So the mood has turned, definitely. A quick recap of the broader markets before we move ahead. Of course, the Nifty in a world of pain, 200 points down, slightly better than what the implied open indicated now. So maybe recovering, but no relief on the broader markets as well. 1% down on the Nifty mid-cap 150, small cap index also hurting 1% down. Actually, all said and done, after a market that has heated up so much, and looking at how global cues were, I would say not as bad. Results impact is dominating the theme on stock specifics. I'll pull up Triveni Engineering, poor set of numbers. It got a beating in the pre-open session as well. And yeah, you are going to see any kind of poor numbers seeing an exaggerated sort of impact as well. So Triveni Engineering, in that sense, maybe it's very, very deserving of what you're seeing, 3.5%, nearly 4% down. Let's talk about Zomato. Zomato is one stock that we identified. Numbers were good, came in just as markets closed yesterday, nearly 8.5% up. on a very, very negative day. And the district launch is what I've earmarked as maybe one of those reasons. Kalyan Jewellers, again, a good set of numbers that you saw, about 1.5% up. We'll in fact be talking to the management in just a bit, so don't forget to tune in for that. Adani End, just let's take a look at it. Jefferies has a target price set at 3,800. Nothing much happening there, 1% down right now. Just look at Dabur as well. A buy rating coming in from Nomura, and mildly positive again, could be a defensive play as well. A quick look at the auto sector and the auto numbers. You saw that seeing a pain point on the Nifty, but remember you had July sales coming in poor for at least these three specifically, and for others as well. You're seeing all of them in the red right now. So more red than green, definitely. Some outliers which are seeing some action, Samina, but overall a tough start to the market.
But look at Zomato. I mean, 8.5%. When was the last time we saw a move like that on the stock? Yes, earnings were good. Yes, brokerages are enthused, but a 9% up move on a morning when the sentiment on the street is actually quite negative. So looking good, record highs in Zomato on back of brokerage upgrades coming in on the counter. 255 rupees is what we had. I still remember last quarter when they reported numbers, the stock was closer to 170, 175 and had largely disappointed the street. So much can change in one quarter. The stock at 255 on Zomato. The Nifty 500 is also trading lower, in line with the benchmark, down nearly 1% from the way we look at it. Auto and auto ancillaries taking it to the chin. So the big losses across the board are being led by auto stocks. Apart from Zomato, you also have restaurants brand Asia that continues to gain. Numbers weren't too bad that were reported a few days ago. The stock saw a block deal take place yesterday and gained 6% in trade, building on that gain this morning, up about 1.5%. Well, Kalyan Jewellers, Tamanna as mentioned, is up about 1.5%. We do expect consumption to not do too badly in trade today, as on back of defensive play. So stocks like Tata Consumer gaining on a day when the rest of the market actually looks quite weak. So Tata Consumer, Kalyan Jewellers, ITC aren't doing too badly as we see it. You've got Godrej Consumers as well that trades with a gain of 0.8%. Dabur is up about 0.5%. Well, some of the other stocks are looking good. Suzlon, since its earnings, has not had a day when it's not gained. Another morning, another gaining session for Suzlon. 2% on Suzlon Energy is what we have this morning. On the sell side, the list is far more extensive. Cummins is down 7%. LG Equipments is down 4%. Maruti, Tata Motors, Tata Steel, Aisha Motors, metals like Nalco are trading deeply in negative territory. Vedanta is also down 2.5%. Tata Steel, 361 VAM, Nuvama, some of your financial stocks as well that have had a good run over the last couple of weeks are seeing some profit taking that's emerging this morning. But all in all, it's a weak start from the look of it. The only hiding spot this morning seems to be Zomato and some of those consumption names that are looking good. Kush, a quick one on Zomato. Would you buy it at this level? Intraday, quick buck could be made, you think? 9% up move, more gains likely over the next couple of hours?
So, Samina, during the pre-open, we were speaking about Zomato, and now what it seems like a mistake. I said, this stock could see 260 to 275 in the coming month. Perhaps, should have rephrased that as, a few hours. That's the kind of move that we are seeing already on this one. But no, not from an intraday perspective anymore. Stellar gap up, it's sustaining. The volumes are also, through the roof just in the first 5-6 minutes of trade. But I don't think an intraday trade is warranted. Even if it does move another few percentage points from here, the risk-reward ratio won't be favorable. But yes, if you've got an existing position, continue to hold on. The stock's obviously, witnessing, a stellar up move, and this could continue for some time.
Significant uptake out there, must say. By the way, a couple of other hiding spots, while not a hiding spot really, but, JM Financial, marginally in the green. There's a lot of traction there too. Actually, Kush, can I come to you? Because you had highlighted this stock as a buy some time back. Do you like it? It's trading in the green while the rest of the market isn't.
Sorry, GM Financial, is that the one we're talking about, Niraj?
Yes.
Sure. So after a sharp run up, it's gone into a bit of a consolidation mode. There are signs of accumulation. So I would consider buying this one, especially given the relative strength that is witnessing at the moment. For me, the stop loss for this one comes in at 98. On the upside, you're looking at 110 as the very first target. and once that is taken out, perhaps 118 as well. So the risk reward ratio is favorable even after the kind of up move that we've seen and the accumulation that we're witnessing at the moment. So yes, this does warrant a buy, at the current juncture.
Okay, Avinash, you mentioned about the water theme and the opportunity there because the market is giving you these lower prices, right? So, is there anything else that you like within that pocket, or is it only the one that you recommended?
No, I think within that theme, there is another company called Jai Balaji Corporation, which is also available at a very attractive valuation. In fact, this is an integrated steel play. They make sponge iron, they make pig iron, and obviously they also make DI pipes. Here the numbers have been slightly flattish, Niraj, but if you look at the operating EBITDA, that is up by almost 20%. So I think clearly, initial reactions for the stock have been negative, but I think electro steel casting has done significantly better. We attended the conference call yesterday where the management was extremely upbeat on the margin enhancement and on the kind of demand order book which it currently has. So I think, we probably, other companies like like EMS, which is into the sewerage space, if it corrects, that also could be a good opportunity because sewerage management in India is going to take off in a significant way. So I think EMS also qualifies as a good long-term bet, if you get it at a decent level, probably in this kind of weak market.
All right. I think a little bit of improvement in the indices, in the key indices as well. And we should at this point also take a call on what you can do with the Nifty and the Bank Nifty. Yes, opened with a bit of pressure as was expected, and global cues set that up completely. But Kush, if I were to come to you and say, what is your intraday call on the Nifty and the Bank Nifty at this point?
So, Tamanna, very interestingly, both the indices have taken support at the key levels. We mentioned 25,800 for the Nifty as the first support, dipped below that, but, we're holding above that. Bank Nifty had this 50-day moving average at 51,000, 51,100 kind of zones, almost like pinpoint, support. But for me, I think, Nifty at the moment is very delicately placed. So I would avoid that. I will still continue with my Bank Nifty short trade, even though, as I said, it's taken support. So you want to be a little mindful of that. But I think once this is taken out, you're looking at another 500-600 points of downside, which is close to 50,500, 50,600 kind of zones. So if I were to take a trade gun on my head, I would actually go with a Bank Nifty short, and Nifty just for the moment I would avoid.
Okay, gentlemen, Kush as well as Avinash, thank you so much, both of you, for joining us today and giving us your thoughts. Really appreciate your time this morning. But the stock of the morning has to be Zomato, and Mahima looks at this very closely and was telling me before the show started about how Blinkit's contribution has gone up, joins in right now with what brokerages or how brokerages have summarized the results of Zomato. Mahima, are they upbeat on the results? Are they upbeat on what Tamanna says, the launch of District, or what is it?
So I think it's a mix of both, but the focus is more towards the upbeat on the results. All the target prices have been raised, and the upside is roughly anywhere between 18 to 20%. Now, to start with, City on Zomato, they've given a target price of 280, which is a 17% upside. What they're saying is that yet another stellar quarter, beating estimates overall. They're saying that they're raising their estimates for their gross order value in food delivery by 2%. And for quick commerce by almost 18 to 16%. And what they're saying is that they estimate CAGR growth of 20% plus in food delivery and 50% plus CAGR in the quick commerce growth. They're also saying that they expect consolidated adjusted EBITDA to grow at a 55% CAGR over 25 to 27 FY27. Now, Nuvama has also maintained a buy on Zomato and raised target price to 285, which is an upside of 20%. It's saying that Zomato continues to deliver its promise of strong growth and improvement in profitability is working in favor of the company. The management is not dialing down on the growth ambition, as the management has guided that they'll complete 2,000 dark stores target by the calendar year 26. And now they are valuing the food delivery business at $14 billion and Blinkit at $13 billion. We also have an Axis Capital note on Zomato, which is given a target price of 287, which is a 23% upside. What they're saying is that consolidated revenue has beaten estimates by 9%, and this is driven by Blinkit. Food delivery growing at a healthy pace. EBITDA of 300 crores is supported by Blinkit despite the strong store expansion. And they're confident in quick commerce, which is evident in increased store guidance. And there is the estimates for FY 25 to 27 by 7 to 12%, and Zomato execution is a beat in class overall. And lastly, CLS has also maintained outperform with a target price of 350. Now, this is a huge upside to the closing price yesterday. What they're saying is that Blinkit is pulling away most of the competitors and driving acceleration in monthly transacting customers. And food delivery is also in the middle game, but with a strategic edge. And they're raising their earnings estimate by 6 to 36% for FY 25 to 27 estimates. So this is the overall view of what brokerages are making out of Zomato.
All right, Mahima, thank you for all of those details. So, as of today, all of those brokerages got it right. If you'd watched our trade setup, you'd know that, we were talking about Zomato as one of the stocks to watch. Yes, it's having a fantastic day. What's not having a fantastic day are the metals. Metals in a world of pain today. The index also hurting. Pull up the components of the index. The metals entire pack is seeing quite a bit of pain. Rakesh Arora joining us now. He's founder at GoIndiaStocks.com. Very good morning to you, Rakesh. Tell us where the biggest concern is coming from. Is it this larger fear of a global recession impacting demand kind of narrative which is driving metals down?
That is one of the things which is actually driving metals down. And metal prices have corrected also in the last month or so. So copper has gone down from $11,000 to $9,000. Aluminum has gone down from 2,600 to 2,200 odd. So there has been a decline, and which has been bearing on the metal stocks. But I think the bigger problem right now is the Supreme Court judgment on the cess, which states can levy on royalty. So that is one of the key issues which is likely to come up in a big way.
About the royalties and the local factors in a minute, but truth being told, we wanted to call you on the show yesterday because we did think with that much expected rate cut in September, metals could be a great play. Of course, the sentiment this morning is exactly the opposite. From where we stand, do you feel like if we get that rate cut, which is largely a given on the 21st of September, and the boost coming in on back of Chinese stimulus, a weaker dollar is always great for commodities. Would you recommend buying into metal stocks tactically for the next couple of months?
I don't think so. This time around, this rate cut is going to have a major impact because there are a lot of geopolitical issues at play here. One is that China is the major driver for commodities, and they have been churning out metal like no tomorrow. So the inventory across the world is going up. That is number one. Number two is that, developed countries are putting up barriers against export from China on most of the new age products, which is like renewables, etc. And if China is not going to produce these products, I don't think the rest of the world has capacity. So all this renewable theme, which was driving copper, aluminum demand, is going to get pushed out. So that's the second factor. And number three is that for Indian companies, we have this big worry on increased taxation. So all these three things combined, I don't think metal stocks have any chance for the next few months.
Really nice.
Rakesh, on the point of the Supreme Court upholding the minerals royalty piece, how does that really impact companies? We saw Tata Steel setting aside about 17,000 crore rupees as an additional cost. Frankly, it didn't impact the stock at least yesterday. Which companies do you think will be largely impacted, and is it that big of a hit?
So some estimates put the total hit just in Odisha to be around 2 lakh crore if this thing is implemented retrospectively. And the other states which had imposed cess earlier were actually Jharkhand and Tamil Nadu. So if it comes prospectively, all the companies who have mines in these three states would be impacted immediately. But going forward also, if it is, hopefully it doesn't come retrospectively, because that is going to kill a lot of industries, players. But if it comes prospectively also, it creates a lot of uncertainty, and margins for all the metal companies in India is going to go down further. And in any case, after the auction regime came in, there was hardly any case for merchant mining in India. And if this such thing comes in, I think then merchant mining is like dead forever. And even for integrated players who have captive mines, the costs are going to go up, so their margins will reduce, sustainably to the lower levels.
Yeah. Okay. Now, while you're pretty certain about new calls in the metal pack, and like you said, it's best avoided for now. But what happens to a bunch of investors who've taken contra calls over the last couple of months and invested into the metal names? Do you feel like this too shall pass, and maybe holding on to these counters is probably wise, or taking your losses off the table and checking out might be a better strategy, because the clouds are here to stay?
So I think Indian metal stocks have done extremely well as compared to the global players, and I think we had a little bit of good run, but earnings are not coming through, and then we have all these issues to tackle. So I think for investors, best to book profits at these levels and wait for some clarity to come back.
So Rakesh, this combination of a local uncertainty, and I'll call it uncertainty because I don't know what the corporates would have maybe given you feedback, because I'm sure you speak to them. But this combination of this local uncertainty plus the fact that there is quote-unquote recessionary worries, does it mean that valuations will be punctured lower for metals currently, or that may not necessarily be the case?
I think we are already trading at the upper end of the band, which has also got extended in the last, this rally. So, there's a good chance that, we might revert back to those lower end of valuation. And I think the conditions are actually prime for that kind of play out.
So, Rakesh, what about specific pockets? For example, Vedanta has announced a demerger of multiple entities, and there are stock-specific triggers to, let's say, that is one stock. There are a couple of others on which the capacity expansion is happening at a breakneck pace as well, and capacity is coming on stream rather quicker than others. Tata Steel yesterday was saying that their H2, because of what's happening in Europe, will improve quite significantly. Are there specific stocks or events that could buck the trend, a Vedanta or a Tata Steel, for example?
Niraj, nothing can actually compensate for a drop in commodity price. Okay. So if aluminum price will drop from 2,600 to 2,200, that $400 is a big miss, and maybe it might go down further. So you can't really fight commodity prices, and these small tick bits here and there is not going to matter.
All right. Thank you for that, Rakesh Arora. They're looking tough for the metals pack, at least for now, and some clarity required on what this royalty judgment really means and how much for each company. That's quite a big figure, actually, that Rakesh gave us. Just in Odisha, the tax hit is being estimated at about 2 lakh crore rupees. Well, a very short break. On the other side, we're speaking with Ramesh Kalyana Raman. He's Executive Director at Kalyan Jewellers. Stay tuned.
back. You're watching India Market Open. It's turning out to be a tough morning, but it's not looking as bad as the rest of the world, at least in the first few minutes of trade. The Nifty 50 is holding on at 24,800, pretty much in line with what we were expecting in pre-open trade. Stock-specific action is driving the street, and defensives, their consumption names, are having a pretty positive day in trade and, of course, softening the blow of global cues. In terms of earnings, Kalyan Jewellers reported numbers after markets closed yesterday. The market seemed okay, they don't seem disappointed, in fact rather pleased. 0.6% gain on Kalyan Jewellers. Ramesh Kalyan, Executive Director at Kalyan Jewellers, now joins in to talk to us about the quarter that's behind us and what lies ahead. Hi Ramesh, good morning. Thanks for joining in. It seems like the markets and brokerages have given the earnings for Kalyan Jewellers a thumbs up, largely better than what the street was expecting. Profitability has been impacted due to higher employee costs, which I believe was planned on back of store expansion, and also higher ad spends. You want to walk us through how the quarter has been and what we should be expecting in terms of volumes and profitability for the rest of FY25?
Yeah, so thank you. Yes, the quarter was good. Q1, the revenue momentum has been very strong. India grew by around 29%. SSGs have been very strong in the range of 12%. It comes with a very high base as well, because last Q1, in the last financial year, the SSGs were 15%. This 12 comes over and above that. And as we speak, July is also trending well, especially after the duty cut. The momentum is further accelerated at the stores. And yes, in Q1, advertisement spends were higher than estimated. It was predominantly in areas where we saw competition from local organized players in a particular region or a store. So the gold prices were also very volatile. So we did not want to go weak on our marketing, and hence the marketing budgets were a bit overshot when compared to estimates. But we spent more on advertisements in the newer markets to accelerate market share gains. Aggressive network addition is also a reason.
Ramesh, hi, good morning. Tamanna here, and stellar set of numbers on the revenue front. Obviously, your EBITDA margins hit this quarter because of expansion plans, so that's obviously seen as a positive. But I'm just wondering when you see a recovery on EBITDA margins and to what extent?
No, so EBITDA margins hit is not predominantly because of that. That is because of our franchisee expansion, wherein franchisee stores come with a lesser EBITDA margin when compared to owned stores. That is the major reason for EBITDA margins to degrow, and it will keep degrowing because our expansion for the next couple of years is predominantly with franchisee capital, and the EBITDA will keep degrowing. Focus should be on PBT margins. In Q1, our estimates was to have PBT higher than our revenue, which is now at same levels because of the marketing spend.
Okay, so just to follow up on that, so you said EBITDA margins are getting squeezed because of franchisee expansion. They come in at a lower profitability. It will continue. Till what extent do you expect a further hit? Give us a range.
So profitability actually in PBT terms, franchisee stores.
We'll come to PBT terms. Ramesh, can you just tell me about EBITDA margins and then we'll come to PBT, please?
Yeah, so EBITDA will be, because our own store EBITDA is in the range of 8%. Franchisee comes with a 5% EBITDA. Okay. And all our expansion is in franchisee, and EBITDA will keep degrowing. So we should estimate EBITDA degrowth for the next 2.5 years.
What extent, sir?
So it will further come down, maybe by say 0.5% to 0.75% over the next 1.5 years.
Okay, so you're seeing it going down to about 6.2%.
But again, I know that you are going to come back to PBT, but PBT will keep growing.
But just before we come to PBT, Ramesh, good morning. There is a belief in a couple of notes that there is a new franchisee agreement that you're going to come out with, which will actually shore up the margins. So can you explain this dichotomy between what you just told, Tamanna, versus what brokerages are estimating?
Yeah, so PBT margins or EBITDA margins are at 5% for our existing franchisee stores. The new stores which we have signed up comes with a 5.25% EBITDA margin. So 0.25 more than before. That's the new model.
Okay. But all things considered same, you're still going to see a hit on EBITDA margins. Let's come to profit before tax now. Since you've been highlighting that is a more important metric to look at. Let's start with why you think it's a more important metric to look at and then where you see that going.
So why? Because our EBITDA margins, because EBITDA, when you go to a FOCO model of franchising, wherein you give a good revenue or a margin share to the franchisee partner, your EBITDA will come down. But on a PBT level, when our own stores are at 4.7, 4.8, the franchisee stores come at 5%. So that is why the PBT margins should keep growing, meaning the PBT should grow more than our revenue. That's our target. But in Q1 it has not happened because of higher marketing spends, because the gold prices were very volatile and we did not want to lose market share in especially new markets where competition was also very active on advertisements.
Okay. Ramesh, I'm sorry, I still don't get the disconnect out there, because if your EBITDA goes down, your PBT naturally will go down. Per se, there's no way that the PBT will do better than the EBITDA growth, right? Unless you are paying off something on interest or depreciation. So I think those rates will commensurately be similar, right?
Yeah. So no further depreciation, because all
got it.
Yeah.
Okay. Now just the growth per se. I mean, the belief was that this whole price downtick in gold prices will lead to an uptick in sales. You have done very well on sales. My question is, what's the run rate that you anticipate for the rest of the year? And has that estimate changed post-budget because of the duty cut?
No, so now when we speak in July, of course, the SSGs are actually better than Q1. And that can be a short term because price came down suddenly, quickly because of the duty impact, and customers started rushing to the stores, especially over the last 10 days and in weekends. And that can be a temporary phenomenon. But midterm, long term, this duty cut is really going to impact or get an advantage for organized players because, the pricing difference between before and now, especially because of duty, the unorganized players, the initiative for a customer to go to an unorganized player further came down because the margins are lesser due to the duty cut.
Okay. So, Ramesh, then if you are seeing a decent July and presumably that continues into August and then we hit the festive season, September, October, are you set for a strong second half of the current calendar? Would Q2 and Q3, which is the current quarter, the next quarter, be stronger than what is anticipated otherwise?
As we speak, yes, we are very upbeat about Q2 and the festival.
Ramesh, just trying to understand, you talked about how the import duty cut helps you because those going to unorganized players might rather come to you. I'm just trying to understand, what was the inventory hit for you? I mean, all players would have had an inventory build up at higher rates. What was that for you?
Yeah, so this will lead to a one-time loss of approximately 120 crore, which will come partially in Q2 and Q3, but yes, it's a one-time.
Okay, so one-time loss of 120 crores that we could see over the next 2 quarters. All right, well, before we round up this conversation, Ramesh, tell us about what you have on the anvil strategically, what is, in plan for the rest of the financial year?
So expansion is on track. We already opened 5 Kalyan showrooms and 2 Candere showrooms in the month of July as we speak. And we will open 35 more Kalyan and 20 more Candere before the festive. And Candere has completed documentation for acquiring the remaining, and it will be a fully owned Kalyan company in a couple of months, and that's the plan.
Anything which you're doing on lab-grown diamonds, that's the hot conversation in your sector right now?
So lab-grown, as we speak, we don't see any demand at our store level. And as a retailer, we will supply if there is demand.
Yeah.
Right. So as we speak, we don't see any demand, and we are closely watching. And lab-grown diamonds, the prices have not been stabilized. So as a retailer, as a brand, we also cannot push because we ourselves don't know where the price is going to settle down. So that is the update about lab-grown diamonds.
Interesting. Thank you so much, Ramesh Kalyana, Executive Director at Kalyan Jewellers, talking about the quarter gone by. 2 or 3 big takeaways from that conversation. For one, He expects EBITDA margins to continue to be hit because they are focusing on the franchisee model where your profitability is at a lower level. So that mix continues. The one-time inventory hit because custom duties were slashed in the budget on gold and silver is going to be about 120 crore rupees. That's going to play out between Q2 and Q3. And what I found particularly interesting, Niraj, because a couple of companies in this space, I also spoke to Senco, is that he sees just no interest in lab-grown diamonds. And this is something which is a rage in Western markets right now. People are ditching your conventional diamonds to go in for lab-grown diamonds, but clearly not in India. Diamonds are a girl's best friend, but they have to be asli. So no lab-grown diamonds here.
Yeah, it's very interesting actually, and it'll be interesting to see if that trend picks up or no, remains to be seen. But real estate has had a mixed day, I must say. The stocks may be lower, but the performances of companies has been mixed is what I mean. So yesterday Prestige had a bit of a struggle on the top line. By the way, the reported top line may not necessarily be the best way to look at the companies any which ways, but Godrej Properties seem to be having a fairly decent showing on their quarterly numbers. So and the guidance of about 22 million square feet for the remainder of the year is also pretty strong. The question only is, will they be able to do that while maintaining their profitability? And I think we spoke to Godrej Properties and started by asking the CEO, Mr. Pandey, about what is it that they believe is in store as far as geographical expansion of their markets go, and what's the kind of run rate that they believe they will clock in. Listen in.
This actually has beaten our internal estimates. Very frank, we did expect a great Q1 start. But some of the launches that we hit the market, especially just to give you some example, we had a launch in Bangalore by a project name called Godrej Wood Escapes. It was one of the most exciting launches for us. But just to give you some context, Bangalore as a business, South Zone as we call it, did about 2,500 odd crores in FY24. So, you would assume a great launch, but to what extent, right? And this launch itself did 3,150 crores. It did higher than 4-year sales of the entire South Zone business for us. So, yes, a great amount of product obsession is leading to that. And I think this is going to be a very exciting year for us because usually our Q1s are very, very slow. As you rightly said, when you look at from a Y-on-Y perspective, it's almost like a 4x kind of a growth. So now with this kind of a head start, the year looks even more exciting.
Would it be like that on reported revenues as well? Because, your reported revenues, they show a number of 21% downtake, right? So how does this even out during the rest of the year, Gaurav? If I want to understand what Godrej Properties could do for FY25 or FY24 or the guidance for FY25 and 26, how do I look at those numbers? Do I look at pre-sales? Do I look at these reported numbers and do they even out? Can you help us here?
Sure. So just to give you some context in the accounting treatment from real estate, especially Ind AS 115, essentially what happens is that your sales happens at, say, point X. The recognition of that in terms of a revenue and into the P&L happens when you get occupancy certificates, right? Like the Q1 launches that we all saw were largely emanating from big bang launches. Our yearly guidance for launch calendar was 30,000 crores. We did about 29% of that as launches. So it's a very launch heavy quarter. But from a P&L point of view, this will get into recognition when OCs will happen, which is say 3 to 4 years from today. So the challenge is if you see the revenue line for real estate companies, especially the ones that follow project completion method, it becomes a bit of a tricky part because you can't really assess P&L because this number on revenue that you're seeing is an outcome of the OCs of sales that happened maybe 3-4 years back kind of project, which were different in terms of its structure, different in terms of pricing, and different market cycle also many other times, right? So how do you assess, real estate companies doing to what extent? There are a couple of things you see. One is a good way to see is the booking value sort of a trend. Not just in isolation, but how is the company doing over a period of time? That gives you an indication of margin profile that you can expect. To give you a sense, we did about 7,850 crores in FY22. We did about 12,200 crores in FY23. And preceding 5 years of FY22, which is say FY18 was about 5,000 crores. So from FY18 to 22, we grew by 50%, some of which is coming into revenue line item now. From FY22 to FY23 moved to 12,200 crores plus, which is like 56% growth. And FY24, we moved from 12,200 crores to 22,500 plus crore, which is like 84% Y-on-Y growth, right? Now, this lag impact in the revenue and the PAT, you will see, say 3 to 4 years from today. So that's one thing. The second thing to see is, this is the first time we have done in our Q4 annual presentation of investors section. We've also published our pro forma P&L, which gives you a sense of imputed margins. So for any analyst who's been tracking the sector, they're able to now assess, they anyways make their own financial model to stack up. But with this added information, it becomes a relatively easier way to predict how the accounting part of this business will look, say 3 to 4 years from today.
Got it. So when I'm looking at your FY25 guidance, for example, right? I mean, on booking value, you achieved 32%, cash collections 20, delivery guidance 18%, business development 15%. Which is it that you would give the most importance to for tracking quarter on quarter, Gaurav?
I think it's a combination of all parameters, but let me take a step back, right? There is, in this business, what happens, there are a few fulcrums. If you control those fulcrums, the outcomes becomes a little predictable. One fulcrum is what we call as, for us, raw materials land, right? So if your land buying is happening consistently well, of course, with the net D within the range that is what is stated by any company, you can predict the long-term growth potential of a company, right? So that becomes very important. Why? It's a forward-looking estimate, not from a near point of view, but next year and the year after that. The second fulcrum is your launches, right? Are you launching on time, and what's your launch performance, pricing point of view, launch volume point of view, and your ability to perform better than the competition, right? So this becomes a very important in-quarter metric. Every quarter you like to measure that. But then this is depend also on the government approval. Sometimes you have an approval delay, the launch moves to next quarter. So from optically, that quarter results may not show very exciting, but if you run the business and you're tracking the sector, it's a movement of one quarter to the other quarter. So again, that's another fulcrum. The third fulcrum is basically completion of projects, right? When is the OC coming? Because that's accounting treatment happens. Now, usually what happens is, if you see our business also, and if you've been seeing Godrej Properties for a while, Q3 and especially Q4 is where the OCs tend to hit. When OC hits, one, profit accounting happens, but more than that, some metrics move with that, like collections. Collections are very lumpy in the last stage of a project. Why? Because projects after structure completion tend to jump up from every milestone. So when you have a Q4, usually you will see much better collections performance. But this is a very interesting Q1 because for the first time, at least to best of my memory, we've seen a dramatic jump from 2,000 crores of last Q1, last financial year, thereabouts, to 3,000 plus crores. So that's an anomaly of sorts.
So if you've done 20% of your collections in Q1, doesn't mean that you could still beat the guided number because your Q4 is when you believe the largest collection number will come about any which ways, right?
Correct.
Okay, great. Good to know that. Now,
I would say H2 for that matter.
H2 for that matter, okay. Maybe with some strength in Q1, but H2, okay. Now, you mentioned a very important point about how land deals, etc., all of that, but while keeping the debt equity ratio in mind, use the term DE. I would love to understand what's the debt outlook that you have with the pipeline that you have and the newer geographies that you're going in.
I think we've always maintained, if you've seen our earnings call for the last 6-7 quarters, we've always maintained we would want to be in a range of net D 0.5 to 1:1 because that's the adequate level to keep a balance between growth at the same time risk management. Our current net D stands at about 0.71. So we have a good headroom to do over and above that. But we are also fortunate that our operating cash flows have started to become very exciting. In fact, if you see our operating cash flows of Q1, they're almost 8x Y-on-Y. It's close to 1,000 crores of operating cash flow surplus that we have. So a combination of operating cash flow and a good net D range that we stated, I think will fuel our sustained growth.
That's Godrej Properties for you. Hopeful of sustaining growth. Should bring up that stock for a moment before we take that break. In fact, wrap it up on this leg of India market open. But the stock is sulking today in line, by the way, with what the rest of the markets are. So, the mid-cap index as well showed a bit of a pullback out after the first 15 minutes, but since then has given way. So look at that, a dip, a pullback, and now is again down about 1% lower, in line with what the rest of the world is doing, by the way. So we're not alone in this. Take a break though. What we try and do is come back and talk to Gautam Duggal about numbers. He's got numbers at the back of his hand and try and understand whether Q1 thus far has lived up to their estimates, and is there a case for fundamentally things to be sanguine? G. Shiv Kumar later on joins in to talk about their quarter, which on the bottom line looked very, very strong. Stay tuned. Thanks for tuning into Talking Point. I'm your host Niraj Shah, and IT is the big sulker in trade today. In fact, Nifty IT is the one which is dragging the markets a lot lower because, much to my surprise, banks are doing a lot better than what IT is. Now, this may be well because Nasdaq has had a bit of an iffy yesterday, but one would have thought that Cognizant's read-through might have been positive and that might have helped Nifty IT, but not quite. Just get the Nifty IT gainers losers on your screen before I get in my colleague Mahima to talk about that one tech platform related name which is bucking the trend. But look at that, the kind of pressure on IT, it's widespread. It's not centered on one or two names. Across the board, there's a bit of a pullback which is leading to Nifty IT lower, and that's a heavyweight index as well, second only to the Bank Nifty, and which is why you're having this bit of an issue with regards to IT. But you know, a tech name which is doing very well is Zomato, and Mahima Johnson to tell us what the brokerage view has been on Zomato for the stock to be up 13% as we speak. Mahima, very quickly, what are brokerages saying?
Right, Niraj. So brokerages are pretty bullish on Zomato, and their upside ranges between 17 to almost 47% now. To start with, Citi, Citi has given a target price of 280, which is an upside of 17% from yesterday's closing. They're saying that it remains their top pick in the internet segment, and they're saying that they're raising the gross order value estimates by 1 to 2% for food delivery and 18 to 16% for the quick commerce. They've estimated the FY27 estimates GOV growth of 20% CAGR, and for quick commerce this is 50% plus CAGR that they're expecting, and overall EBITDA growth of 55% CAGR over FY 25 to 27 estimates is what they're saying. Nuvama is also bullish on Zomato, given a target price of 285, which is an upside of 20%. They're saying that management is not dialing down on growth addition, and they're now valuing the food delivery at $14 billion and quick commerce at $13 billion. Axis Capital again bullish on Zomato with a target price of 287, where they're saying that consolidated revenue has beaten estimates by 9%. EBITDA of 300 crores is supported by Blinkit despite the strong store expansion that they're doing, and they're raising FY 25 to 27 estimates top line by 7 to 12%, and they're also saying that Zomato execution is best in class. Lastly, CLSA has maintained outperformance with a target price of 350. Now this is the